Hello friends, in this lecture we are going to discuss types of banking risk, and first such risk we are going to discuss is liquidity risk. In liquidity risk, first its meaning. Friends, inability of a bank to get funds at a reasonable interest rate when these are required to meet cash flows is called liquidity risk. So banks obtain funds in the form of deposits, in the form of borrowing or refinance, and they try to get these funds at reasonable interest rate, and these funds should be available to them when they require to meet their cash outflows. But if a bank is not able to obtain these funds at a reasonable rate, that type of situation is called liquidity risk. Now, what are the reasons or sources of liquidity risk? Friend, liquidity risk arises because assets are financed with liabilities having different maturity period. So assets created by the bank, they have different maturity periods, and those liabilities which fund these assets, they have different maturity period, and this leads to liquidity risk. Let us see this example. So here we have different maturities of assets liabilities. We call them maturity buckets. This is the amount of assets and this is amount of liabilities with maturities falling in these buckets. Let us see. We have these three buckets: 1 to 7 days bucket, 8 to 14 days bucket, 15 to 28 days bucket. During this period, the amount of assets which is going to be realized is 10,000 during this period, 15,000 during this period, and 18,000 during this period. On the other hand, the liabilities which are maturing means the payments which bank is to make during this period are 12,000 during this period, 14,000 during this period, and 16,000 during this period. What is result of this? The result of this is that maturing assets are less than maturing liabilities. Means their realizable amount is less and payable amount is more. So there is a negative gap of 2,000. And in this bucket, the maturing assets are 15,000, maturing liabilities are 14,000. So there is a gap of 1,000, but it is positive gap. In the same way, there is positive gap in this maturity bucket. Now, if bank has to pay its liabilities on time, then bank will be requiring this amount of funds to be raised from the market at reasonable interest rate, maybe in the form of deposits or borrowing or refinance. And this can create some difficulty for the bank. This may result into higher interest rate, and that would lead to higher cost for the bank. So this type of situation leads to liquidity risk. Now liquidity risk takes different forms. Let us see what forms are taken by liquidity risk. One is the funding risk. Second is the time risk. The third one is the call risk. So these forms of risk we shall discuss in some different video, But for the time being, let us see what is the impact of liquidity risk. From this picture, we can see that there is negative gap of minus 2000. So this much money has to be mobilized by the bank. And that has to be done during this period. It is possible to meet this liability. The bank raising these funds may be getting these funds not at reasonable rate. These may be at a higher rate. If that happens, that would lead to increased cost of money for the bank. Means increased interest expenditure. So that would affect the net interest income of the bank. So liquidity risk can always impact net interest income of the bank adversely. Well friends, thank you very much for watching this video. And thank you once again